Want to own a slice of a world-class business? Like the idea of profiting from products that practically sell themselves in this environment? Looking for a yield that beats the market and dividend growth that beats inflation? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is the largest prime defense contractor in the world. What do we know about our world? We know that it is full of uncertainty. In my 40 years of being alive, I don't think I've ever experienced a day that wasn't uncertain. Well, this company benefits and profits from uncertainty. And the more uncertain things get, the more profitable they can become. With uncertainty cranked way up right now, this business is positioned very well. And that positions its revenue, profit, and dividend for plenty of growth ahead. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explained exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Lockheed Martin Corporation, which appear to be trading at a significant discount today. Lockheed Martin Corporation, stock ticker LMT, is the world's largest defense contractor. Founded in 1912, Lockheed Martin is now a $104 billion by market cap global defense monster that employs nearly 115,000 people. The company reports results across 4 segments: aeronautics 40% of fiscal year 2021 revenue, rotary and mission systems 25%, space 18%, missiles and fire control 17%. The U.S. Department of Defense accounts for approximately 62% of revenue. Nearly 25% of revenue is derived from foreign government militaries. The remaining 10% comes from various U.S. government agencies. Commercial sales are immaterial. The company manufactures a range of major military aircraft platforms, including the F-35 Lightning II, the F-22 Raptor, the F-16 Fighting Falcon, and the SH-60 Seahawk. The F-35, a 5th-generation combat aircraft, is the largest and most expensive military weapon system in the world. In addition, their various missile programs are critical for both offensive and defense capabilities. Uncertainty is part of our everyday lives. In my 40 years of being alive, I can't remember a single day that wasn't uncertain in some shape or form. Lockheed Martin benefits and profits from this constant uncertainty as the company provides the sovereign defense tools necessary for nations to protect themselves against possible outside threats. Because uncertainty is a bottomless well to draw from, and because conflict is part of the human condition, defense contractors are practically guaranteed ongoing sales for a time period that stretches beyond my lifetime. Furthermore, these sales become increasingly larger in terms of dollar figures. Defense tools continue to grow more complex and more expensive over time. It's inherent progression layered onto built-in demand. What's especially powerful about Lockheed Martin is that it's the world's largest defense contractor, headquartered in the world's largest spender on defense products and services. Lockheed Martin has a unique combination of scale, positioning, and quality. This sets them up to deliver growth across its revenue, profit, and dividend for many years to come. Already, the company has increased its dividend for 19 consecutive years. The 10-year dividend growth rate of 12.5% further shows what a stalwart Lockheed Martin has been. Along with that double-digit dividend growth rate, the stock offers a competitive, market-beating 2.8% yield. This yield, by the way, is 20 basis points higher than its own 5-year average. And with a balanced payout ratio of 52% based on the company's earnings per share guidance for this fiscal year, the dividend is healthy and positioned to continue growing. I like dividend growth stocks in what I refer to as the sweet spot, a yield of between 2.5% and 3.5% paired with a high single-digit or better dividend growth rate. Both the yield and dividend growth rate are great and clearly in that sweet spot. Looking at business growth, Lockheed Martin escalated its revenue from $47.2 billion in fiscal year 2012 to $67 billion in fiscal year 2021. That's a compound annual growth rate of 4%. Solid. I like to see mid-single-digit top-line growth from a mature business like this. The company delivered. Meanwhile, earnings per share grew from $8.36 to $22.76 over this period, which is a compound annual growth rate of 11.8%. Strong bottom line growth here. It's great to see that the 12% plus dividend growth has been fueled mostly by like earnings growth. This shows prudence on the part of management with a clear eye on sustainability. A lot of the excess bottom line growth was driven by share repurchases. The company's outstanding share count has been reduced by 18% over the last decade. Looking forward, CFRA believes that Lockheed Martin will grow its earnings per share at a compound annual growth rate of 6% over the next 3 years. So we can spot a clear disconnect here. This forward-looking growth forecast from CFRA is about half of what Lockheed Martin has demonstrated over the last 10 years. What gives? Well, I think there's a push-pull dynamic going on here. Labor shortages, material shortages, and overall supply chain issues are impacting the business in a material way. Recent quarters have been impacted by these challenges. Offsetting these difficulties is a very strong core business, which is only getting stronger on the back of geopolitical environment that has become red hot after Russia's invasion of Ukraine. Open war in Eastern Europe has the world on notice, and defense spending almost across the board is rising. That obviously bodes well for the world's largest prime defense contractor. After all, the company provides a necessary suite of products and services to willing buyers who have near unlimited purchasing power, and it does so while sitting atop a powerful oligopoly. Indeed, Lockheed Martin's contracts just keep piling up. The latest news is that the company is nearing the closing of a $30 billion deal with the U.S. Department of Defense for several hundred F-35 jets over the next few years. The backlog is already sitting at $135 billion. Lockheed Martin is not short on work. While the next year or two could be choppy as the global supply chain is still straightening itself out, the company's long-term prospects are fantastic. I don't find CFRA's take on near-term earnings per share growth as unreasonable, but that still sets us up for high single-digit dividend raises over the next few years. Then, as the business gets back to full strength, we could see a nice acceleration in dividend growth. That paints a nice picture in my view when you're already starting off with a near 3% yield. Moving over to the balance sheet, the company sports a rock-solid financial position. The long-term debt-to-equity ratio is 1.1, while the interest coverage ratio is over 16. Profitability is fairly robust, and it's been steadily improving. Over the last 5 years, the firm has averaged annual net margin of 8.7% and annual return on equity of 279.2%. Return on equity has been greatly helped by the balance sheet, but the improvement in net margin, routinely in the 6% range a decade ago, is notable. They say the strong only get stronger. Lockheed Martin is a classic case of this. The current geopolitical environment is leading to even more dollars flowing toward a powerful oligopoly where Lockheed Martin reigns supreme. And with global scale, high barriers to entry, long-term contracts, unique government relationships, R&D, IP, and technological know-how, the company benefits from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. The industry's oligopoly does limit competition. On the other hand, direct government relationships can lead to more regulatory risk. The very business model presents geopolitical risks. Production execution is a risk. For instance, cost overruns on the F-35 program have plagued the firm. Any reduction in U.S. government spending, which would put pressure on DoD spending, could weigh on the company's revenue and profit. That said, CFRA's found that, and I quote, government defense spending has historically increased regardless of recessions, unquote. Moreover, CFRA cites Lockheed Martin's focus on, and I quote, advanced technology programs which are likely to avoid cuts even if total defense spending is reduced, unquote. I see these risks as acceptable, especially when lined up against the quality and appeal of the business. And with the stock down nearly 20% from its 52-week high, the valuation only serves to make this name that much more appealing. The forward price-earnings ratio is sitting at 18.5 based on the company's earnings per share guidance for this fiscal year. For a world-class operation like this, I think that's more than acceptable. For the sake of comparison, the stock's 5-year average PE ratio is 22. We can also see that the price-to-cash flow ratio of 12.1 is well off of its own 5-year average of 17.1, and the yield, as noted earlier, is higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7.5%. This dividend growth rate is on the high end of what I typically typically allow for, but it's not as high as I'll go. I see this as a highly realistic expectation for Lockheed Martin's dividend growth path from here. It's not far off from the dividend raises the company has been handing out of late. Keep in mind, the most recent dividend increase came in at 7.7%. Supply chain kinks will likely put a low ceiling on dividend raises over the next few years, but the moderate payout ratio and strength in the underlying business should allow dividend growth to climb higher when we look out further. I think Lockheed Martin could very well exceed this mark over the long term, but I'd warn that the near term may be bumpy. Either way, I like to err on the side of caution. The dividend discount model analysis gives me a fair value of $481.60. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Lockheed Martin as a 4-star stock with a fair value estimate of $447. CFRA rates Lockheed Martin as a 3-star hold with a 12-month target price of $414. I came out on the high end, but we all agree that the pricing seems too low right now. Averaging the three numbers out gives us a final valuation of $447.53, which would indicate the stock is possibly 12% undervalued. Here's the bottom line, guys. Lockheed Martin Corporation sits atop a powerful oligopoly that is benefiting and profiting from current global affairs. The growing backlog already exceeds the company's entire market cap, indicating no shortage of work now or at any time in the future. With a market-beating yield, double-digit dividend growth, a moderate payout ratio, almost 20 consecutive years of dividend increases, and the potential that shares are 12% undervalued, this looks like a compelling idea for long-term dividend growth investors. And now for a special news announcement. Apple Inc., stock ticker AAPL, is kicking its vehicle development program into high gear. They just hired Luigi Taraborelli, former head of chassis and vehicle dynamics at Lamborghini. Taraborelli helped to design the Urus, Huracan, and Aventador models. The total addressable market in the mobility space is massive, and it's actually a potential needle mover for a company as big as Apple. I've repeatedly called Apple a must-own stock for serious long-term dividend growth investors, and this news only makes me more excited about the company's trajectory. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It'll allow me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.